Right, in this second section of Business Basics, we're going to cover some of the things you need to do to build a business model. So, if you want to build a business model, you need several things. You need a strategic vision of the markets, the competitors, and the way forward for you. You need to be able to communicate it both to your own staff and to the people that you want to sell to. You need to have some expertise in how to market, in IT, and in new product development. You need a balanced scorecard approach, which basically enables you to track different things in different areas of the business, and I'll come back to that in a moment because it's very important. You need to be able to do some strategic networking, and above all else, you need to have some structured human resource and training built into the business, because that's what motivates your staff, and all the evidence shows that actually doing all that boring hygiene HR is what really works in getting your staff to run the processes that you need to maintain your brand with the customer. You see, you need all of that stuff to make sure that you can deliver a proper service, because that's what people are going to remember and why they will come back to you. And that's what will build your brand and develop the value in your business. Now, we need to then consider the things that you actually need to be on top of in order for things to work effectively. I'm a great believer in what I've come to call the 3 laws of marketing. It's kind of a spoof on the 3 laws of thermodynamics, actually, but the first law says you only sell things that people want to buy. The second law says if it's going to fly, it will do so quickly. In other words, if you come up with a new product and you test it and you get some acceptance early on, then you know that it's going to work. If you don't, then you can spend an awful lot of time throwing money and time and energy at improving a product that's never going to work. And finally, the third law could be summarized as to take the money and run. By that I mean you have to be able to take some cash out every day. It doesn't have to pay for itself initially, but it does have to have a means of getting a flow of value, of money coming in. If you can't do that, you've got nothing to leverage. So you really do need to spend as much time as you can trying to create business models that self-fund, that give you something back every day. Of course, we're not selling things in a vacuum. We have competition to contend with. And one of the things you need to know is to know who your competition is and how good they are. And bear in mind, your competition may not be who you think they are. If you ask people generally who are the biggest competitors for Harley-Davidson, they'll come up with the name of another motorcycle company. But the truth is that actually, if you think who buys them, they're middle-aged men who want to recapture their youth. Who's competing for that money? Their wives are competing for that money, and they probably want to spend the money on a conservatory. So actually, Harley-Davidson's biggest competitor is probably Anglia or Everest. So you need to know who your competitors are, and you need to know where you have advantage over them. You can analyze the competition according to a number of different criteria where you have the advantage and where they don't. This, just as an example, is the Amazon value curve compared to a traditional bookstore. And you can see that the bookstore kind of wins on speed and face-to-face advice, but it loses out in choice, convenience, and price. Now, as time goes on, we're all educated to want things cheaply and quickly and efficiently, so that, in fact, gives Amazon their overall advantage. As well as competing with the competition, you're also competing with your customers in one specific way, and that's for the amount of the surplus value that you have created that you are going to retain, and how much the customer is going to obtain in the way of discounts or other services. This is a slide which illustrates the process of value creation. Fundamentally, there is a value which a consumer might be considered to pay for it. The maximum amount that a consumer might pay is actually the something called the maximum reserve price. It's the point at which the last fool says it's too expensive. So that's the maximum amount of money that could be achieved. You then have costs in producing the product itself, and the difference between the costs and the maximum reserve price is the amount of value that's potentially created. Now, the reality is you're in a battle with the customer for how much of that value that you created you can hold on to. This is called value capture. So there's the amount that you capture, and there's the bit that you lose to the customer, which is called the consumer surplus. And the sales price will be set somewhere in between those two. Now, there's an interesting theory for setting optimum pricing, which says that the optimum price that you might charge is halfway between that maximum reserve price and the costs, all of the costs that it takes to produce, deliver, and distribute and package the goods. If you set it halfway in between, then the amount of revenue that you will generate will be a maximum. If you sell it at the maximum price that you could possibly get, then you're only going to get one sale. If you sell it at the just over cost, you're going to make lots of sales, but you're going to make no money. So what this graph shows you is that you want to try and push the sales price up as far as you can towards the maximum potential, but in reality, you'll get the most return probably if you set it at halfway through the maximum price you could possibly get and whatever it costs you to produce the offer. Okay, the final piece of the jigsaw on the costing side is to know where you break even. What this says is how many of them you need to sell in order to actually start making any money. Now, probably many of you will know this, but I'll just review it quickly because it's important. Fundamentally, you have a variable cost of making the product, so that each new one that you make or each new thing that you deliver has a cost to it. This will be things like the labour involved or the materials that are involved in using it or the packaging or the delivery costs. Then you have, in addition to that, you've got something called fixed costs. Accountants call these overheads. This is the cost of keeping the business in existence. For a particular product, it might be you may have some tooling or setup costs, and then you have the cost of having the staff to man it, and the administrative services, the IT, the premises, all of those kind of things. Those are fixed costs. So you've got a certain amount of money which you make for each sale that you make, and you have a certain incremental cost for each item that you sell, and you have a level of fixed costs. And so before you sell anything, you've got a level of fixed cost which has to be covered. Then every time you sell one, you incur some costs and you make some money. And at a certain point, the revenue line will cross first the fixed costs and then the variable fixed costs at variable costs. And you need to be clear how many items you have to sell to break even. Because if you can't do that, then you're never going to make a profit. And every additional item that you sell is going to result in a loss. So that's not a sustainable situation. So you have to be clear where these things are. Now, as time goes on and you produce a greater volume, the variable costs may actually decrease. This is called the learning curve. But it's also true that in order to sort of continue to ramp up, you may have to increase your fixed costs from time to time. I've shown it there as a line, but in reality, it may be a stepped function. For instance, when we were expanding plants for Presence business, we had to buy a nursery and the capacity to meet the demand, which we couldn't do from running the business from home anymore. Now, we had far more space, and it cost us far more than we would actually needed to pay at that time. But we had to, but having made the provision for the future by stepping up the fixed costs, it meant that the amount of volume that we could put through became much, much greater. We haven't actually exceeded it yet. So we've been able to continue to expand the business year on year for the last 6 years, and we're still growing into that space. So although we have long since actually covered the costs of doing it. But in order to do that, you have to know that you've got sufficient volume, and you have to know before you undertake things like that whether the business is scalable, i.e. it's limited by demand, or whether it's non-scalable. In other words, it's limited by the amount of product that you've got to sell or the amount of time that you have to sell if it's a consultancy business. Right, I'm going to talk a little bit about how you measure the value of your business now. Now, why is this important? Well, it grows out of the need that at some point you probably will want to sell the business on or otherwise realize its value. And you have to know how to value it. And you also know how to track the growth of value in the business. Now, what is the value of a company? A rule of thumb would say that it's about 3 to 4 times the level of annual earnings. So, for instance, when we bought our Ladybird plant care business from one of our suppliers, we paid around 3 times the amount that it was delivering on the bottom line. In the case of a quoted company, it's quite straightforward. You can get the market value of the company, which is effectively the number of shares times the share price, and you can deduct from that the tangible assets. However, it's a bit tricky to do that because actually most of the value in businesses these days is intangible. We'll talk about that in a bit more detail in a minute because it's important. However, another way of looking at brand value is actually what you might call the value of passive sales, the premium over what you get from mechanical marketing. If you market via some kind of sausage machine approach, like you're using AdWords to generate traffic through a website, or you're basically doing direct sales on a face-to-face basis, you can actually measure how much effort and how much money you need to put in to generate a certain amount of result. What your brand value does is actually gives you free sales over and above that because your reputation and the strength of your image is strong enough to generate extra sales. So those are kind of ways of looking at what your brand value actually might be. I've put a couple of other definitions there from Young and Rubicam and Moran up for completeness, but actually the first two are probably most important in a practical sense for those of us who are running businesses that we want to grow and maybe ultimately sell. Now, as I was saying just now, most value in a modern business is actually intangible. Strassner, who's a sort of professor of economic warfare at some American university, says that actually it represents 80% of modern businesses. And if you think about, what's the value of Coca-Cola? It's all in the brand. There's nothing very much in the product itself. It's all in the desire for people to buy it. That's exactly what I was talking about the value of the brand driving you additional free traffic. Now, what is this intangible value? Well, in a way, that's why it's important you heard me talk about balanced scorecards. This is a way to get at it because value lies in what's in people's heads and how innovative they are. If you've got an innovative team, that has a value because you can keep coming out with new profitable products. It lies in formal intellectual property rights, that's trademarks, royalties, that kind of thing. It lies in the customer base and how loyal it is. It lies in the processes of the company, how reliable and effective they are. And it lives in the company's contracts and its financial strengths. As I mentioned, a company is generally worth about 3 times its annual earnings. But what is the brand? The brand is really all about how reliable your delivery processes are, how likely people are to come back and buy more stuff from you. That's the basis of an income stream, and it's the income stream that you will sell on. Now, if you talk to an accountant about what you do to make a company ready to sell, you basically artificially boost the sales and hold back the expenditure so that you're actually boosting that figure of the annual earnings. But supposing you don't actually want to sell the business for some time, you need a logical way of actually tracking the growth of value in the business year by year. And that's where the balanced scorecard comes in. As you remember, we had these different focuses: innovation, people, customers, systems and process, financial focus. How are you actually going to track that? Well, you need, in a small business, to have a sort of dashboard, if you like, something which gives you a couple of indicators in each area. And having looked at some of the things that they had done through the sort of Cranfield Business Study Analytics, these are the ones that I would suggest you might consider. For innovation, you might consider the percentage of business you get from new products and the percentage of money that you spend on R&D as a percentage of turnover. That will give you an indication of how innovative the business is. People is an interesting one. One good measure is how much training you give per employee, because frankly, we know from all the evidence that if you do the basic HR stuff of having an annual appraisal, asking them what worked last year and what didn't work and what they need to know to do their job better next year, and you build the training that they require into your budget, you'll perform better than companies that don't. So that's one good measure. The other is actually either absenteeism, people taking sickies, or accidents, because it's known that the satisfaction of people with the company, with their workplace, correlates with how many sickies they pull and how many accidents they have. Now, you have to track the accidents by law in the accident book, so you've got a very easy surrogate for people's satisfaction right there. In terms of managing your customers, percentage new customers is a good thing to measure. The attrition rate is such that most companies lose about 7 or 8% of their customers every year, and the average British company just keeps pace with it. So if you've got a percentage of new customers that's ahead of that, then you're doing all right. The other thing you want to measure is complaints per customer, because that tells you how well you're doing and how well your systems are. Now, in terms of actually also looking at your systems, you might want to track debtor days or creditor days. That's how good your finance people are. Tracking creditor days actually is quite a good thing to do, because what always knocks you off the course is somebody that you've forgotten about who you owe money to. You know who your debtors are. They're burned into your frontal lobes. So either of those is a good thing to track on a dashboard for knowing how effective your systems are. The other thing you might want to track is value added per employee, because that will tell you how profitable the business is on the whole. Then in terms of the sort of financial focus, you might look at return on capital employed, pre-tax profit, and actually the acid test ratio, which tells you that if you had a crisis, how much cash could you raise. The acid test ratio is cash and readily available stuff, debtors relative to your company's debts. It leaves out stock because you might not be able to realise that quickly. So if you track those things, then you know that you're doing well in all of those areas, then you know that all of those things which contribute to the growth of value in the business are doing all right, and you could be sure that the growth of the business effectively is on track. And I think that's important. So coming back to the detail of how you're going to build a business model that's going to work, you need to know the answers to these questions. Who's going to buy it? How much are they going to pay for it? And what's it worth versus the alternatives? That's why I asked you at the beginning of this section to sort of look at the profile of the competitors and also about the value creation bar chart, how much you can actually retain of the maximum reserve price. Then you need to know what's the cost of making one sale, the cost of delivery, and your profit per sale. All of that stuff feeds into that break-even analysis that we looked at. Then you need to know where will they find it. And then finally, you need to know how many sales per month you can make. What's the potential for repeat business? Can you build up the loyalty factor, or is it just going to be a series of one-offs? And then you need to work through the sums and work out what the pressure points. Your business is about the process of knowing how much slack you've got, how much you can push in that direction, where the constraints are. If you know what those are, then you can manage. If you don't, then you're basically flying by the seat of your pants, flying blind. So again, here are some of the things that you need to cover. Where do you get your raw materials? How do you make it? What does it cost to make it? How is it sold? Via who? How do you pay them? What do the wholesaler, retailer, consumers pay? What's the structure of the pricing as you go through the distribution channel? What's the positioning? How do the users think about it, and how do they find out about it? What are the barriers to entry? Can you keep the competitors off? And how do you make it bigger? How do you scale the business? How do you buy the capacity to allow you to scale the business? These are the things that you should try and plan in from day one if you want to be successful. Right, as if all that wasn't enough, you then have to think about your return on capital employed. It's not just enough to make a profit, you have to make enough to go forwards. Because if you're not making at least 12% on capital, you're a value destroyer, because it will cost you 6% to borrow it. The inflation is, in practice, still at around 3%, and you will pay another 3%, i.e. 24% of the profits, in corporation tax. So that means that if you're not making more than that, then you're not going forwards, you're going backwards. Anyway, that's enough for now. Okay, thanks for staying with it. This is the end of the part 2 of Business Basics, and in it we've looked at the things that you need to be aware of, where your break-even point is, what the competition is up to, how much of the surplus you can retain versus the customer, and the sort of kind of things that you ought to sell and how you know whether it's working. We've talked about how you track the growth of value in your business so that you know if you're going in the right direction. And finally, we've reviewed some of the things that you need to have to be part of a successful business model. I would just reiterate that you do need to know how to grow the value of your business, and you need to have good systems because that's the basis of your brand. It's not to do with the sort of logos or the image, although that's important. It's to do with what the experience that the customer has. So that's the end of part 2. In part 3, we're going to look at the sort of barriers to growth and some of the things that people do to overcome them. Thanks very much.